$80,000. That's the massive new milestone Bitcoin just surged past for the first time since May. What we're seeing here is a remarkable weekly rally driven entirely by a powerful risk-on sentiment as capital flows heavily into alternative assets amid broader currency fears. Hello everyone, welcome back to AI Market News. Today, we're breaking down a truly massive week ahead for all of us. Our focus is Iran sanctions, sink oil, Nvidia, and Video Week begins. This week is absolutely defined by a sharp collision of geopolitical tension and intense tech anticipation, and it carries significant implications for all of us navigating the global markets.
Section 1, Geopolitics and Oil Prices, and the Impact of Operation Economic Outcast. The week opened with the U.S. launching a sweeping secondary sanctions campaign against Iran, designed to economically asphyxiate Tehran by targeting its broader trade networks. As we can see in the chart, the market's reaction was swift. West Texas Intermediate, or WTI Crude, experienced a sharp drop, falling over 3% to the $82 range. Based on available data, energy markets are aggressively pricing in these geopolitical shockwaves.
But why exactly does this move the market so violently? It all comes down to secondary sanctions. By threatening to bring the full weight of the U.S. financial system against global shipping and financial institutions, the U.S. is signaling intense diplomatic pressure. Markets immediately interpret this as a chokehold on economic activity, which mechanically lowers future global oil demand.
Section 2, Tech drags U.S. equities, resulting in a market divided.
Looking at U.S. equities, the week opened in a highly bifurcated fashion. The major indices definitely didn't move in lockstep. The graph shows the Dow Jones Industrial Average remaining incredibly resilient, bucking the downward trend to gain 140 points. Conversely, the tech-heavy Nasdaq took a hit, dropping 0.76%. This decline was driven largely by a semiconductor sell-off, hitting key players like Micron and AMD particularly hard. What we're witnessing here is classic sector rotation. Investors are currently locking in their profits from high-growth tech stocks, like those semiconductor companies, and moving that capital directly into safe havens like healthcare and financials. This deliberate move towards safety is a direct response to the rising geopolitical uncertainty we're monitoring across the globe. Section 3, Yields and the USD/JPY, USDJPY, examining the currency connection. We're seeing a distinct retreat in the bond market right now. As we can see in the chart, the U.S. 10-year Treasury yield has fallen to approximately 4.61%. This is a rapid and notable shift from just last week, when that 10-year yield was testing highs around 4.74%. This dynamic is absolutely crucial for all of us tracking cross-border capital flows. So, why are yields dropping so suddenly? According to current market information, the Treasury Department might draw down its cash reserves to inject fresh liquidity into the broader market. This influx of liquidity increases the demand for bonds, pushing bond prices up. And because bond prices and yields always move inversely, this dynamic mechanically pushes the yield percentage down. This directly affects currency pairs, specifically the USD/JPY. As US yields fall, the interest rate gap between the United States and Japan begins to close. This narrowing differential mechanically eases the upward pressure on the dollar against the yen, leading to the broader fluctuations we're tracking for all of our Japanese investments. Section 4, Nikkei and Japanese markets, navigating global headwinds. Turning our focus homeward, the Nikkei NIK 225 is currently experiencing incredibly cautious trading. As the graph shows, the index is absorbing a dual impact: the drag from the U.S. semiconductor sell-off alongside the shifting currency dynamics we just detailed. Furthermore, the market is bracing for key domestic data, specifically the upcoming Tokyo CPI release. Adding fuel to this caution is global trade friction. With U.S.-Canada trade talks breaking down over the weekend, we're seeing threats of severe 50% tariffs on Canadian exports starting in 2027. This type of escalating friction fundamentally dampens sentiment in export-heavy markets like Japan, severely compounding the current cautious outlook for equities we're navigating. Section 5, Key Economic Calendar Ahead, Preparing for a Data Supernova. As we look at the back half of the week, we're entering a defining 72-hour window. The economic indicators released in this period will likely dictate the market's overarching direction for the remainder of the month. On Wednesday morning at 8:30 a.m. Eastern Time, we received the July PCE Price Index. After Wednesday's close, Nvidia reports its highly anticipated earnings. Thursday marks the opening of the Jackson Hole Symposium, culminating on Friday at 10 a.m. Eastern Time with a critical keynote from Fed Chair Warsh. So, what's our playbook for the days ahead? It really comes down to 3 steps. Assess the inflation data, evaluate Nvidia tech revenue, and parse the central bank's tone. If inflation runs hot and the Fed sounds hawkish, we need to brace for a bond sell-off. But if the data cooperates and Nvidia delivers, this dip could be a major strategic buying opportunity for all of us.
The pieces are moving fast, from Middle East sanctions to a pivotal tech earnings call. The question is, will this week's data supernova trigger a massive market rally or push us further into a defensive crouch? We'll just have to wait and see how the market digests all of this. Thanks for watching. Please subscribe and hit the like button. This video was automatically generated by Gemini Notebook AI. AI-generated content may include errors. This video does not constitute investment advice. For full details, please check the description below.